The VIX is up 2 handles since last Wednesday. What other signs prevail that above average volatility may emerge? We'll discuss today on Open Interest. Hello everybody, I'm Mike Coe. Welcome to Open Mic, where we take your questions and try to figure out the answers together. But before we get to that, some food for thought. I was reading earlier today that Mark Cudmore, who's the executive editor for a Bloomberg blog who's based in Singapore, made the following observation. He said that July saw the largest surplus of stories including the word bullish relative to articles including the word bearish since May of 2018. And what's even more remarkable, by his reckoning, is that while July was the most net bullish by this metric for Bloomberg News in 86 months, only 7 of the 120 months in the sample saw stories using the word bullish exceed those that use the word bearish by more than July 2025 did. They were August, November, and December of 2017, as well as January, February, April, and May of 2018. And he was curious if these proved to be a coincident or a leading indicator. And it turns out that they proved to be very much a reverse indicator for the future. So in those 7 months, the average return of the MSCI All Country World Index was 80 basis points, exactly in line with the full 120-month sample. So there's no coincident bias. However, over all future periods, these months underperformed the average from the full sample period, which includes these months. Note that with only 120 months total, the 12-month forward returns are only for 108. 6 months forward returns for 114, and so on. So when bullish Bloomberg News stories exceeded bearish Bloomberg articles by more than they did in July, the average returns relative to the full sample for 1 month was 20 basis points versus 90 basis points, so underperformance of about 70 bips. The 3-month was 50 basis points versus 2.4%, so underperformance of 190 basis points, and the 6-month was down 60 basis points versus an average of 4.8% returns, and the 1 year was negative 2.5% versus a return of 10%. So anyway, I thought that was kind of interesting. One thing that I also find a little bit interesting about that is that Bloomberg is, it's not the most conventional source. It's not like social media. It's not like Google News or anything like that. It's definitely a narrower subset of market participants, market viewers, market writers, frankly. But I did think that that was interesting. So in the midst of all of that, so this is kind of back, we're looking back a little bit because this just came out, but he was observing that this was sort of the news coming into this month. And we've previously observed that September has above average volatility relative to all months going back a century. October has still higher average volatility, as does November. So, might this be a similar situation? Again, that's for the S&P 500 centuries worth of data, or the closest approximation we can have to the S&P 500. And as I previously pointed out, there will be included in that a couple, unusual data points, like the crash in 87 falls into that, the crash in GFC, the first one, the Lehman Brothers default, falls into that series of months. So you have some really unusual circumstances, dropping into, is it by coincidence? I don't know. But what I can say is that if you have a situation where the VIX goes to 80, sort of a GFC Lehman type of a moment, or you have, a pre-VIX record one-day decline like you did in the crash in October of 1987, those types of things are going to skew the data. So it's important to pay attention to the notion that you can have something that is above average volatility, but not necessarily more frequent volatility, if that makes sense. Okay, so I just sort of wanted to have that in the background. We'd previously talked about mechanisms for hedging through the end of September, partially because I thought the FOMC would probably be, number one, really watched very carefully, and number two, it was not clear to me that the path was wholly set in stone. It seems like we're really going back and forth on that. Now, I noticed that we got a question about this already, and so Ranjana Gupta asked a question about a single stock, and I'm going to get to that because I think it's interesting, and I'm glad to see the name that he's looking at. But in the context of this volatility and sort of the macroeconomic discussion, I was going to take Jim Howard's question first, which was, can you talk about the Friday non-farm payroll report range expectations, 75,000 estimated, and thresholds for substantial impact plus or minus, plus future revisions. So I think this is, an important question. So let's just take a look at this first. So indeed, as Jim points out, 75,000 is the expected add for non-farm payrolls. I can confirm that that is still the number. Let's do that together. While I just take a look here, we'll actually pull up these numbers. Okay, so we have a bunch of labor data coming up. We have some Thursday, and then we have some Friday as well. So the first thing that people are going to be looking at is the ADP employment change numbers. The employment change numbers, we're going to be getting those numbers at 8:15 on Thursday morning. We are then going to have initial jobless claims 15 minutes later at 8:30. That number is expected to be 230,000, which was almost exactly the same as what the previous period was, which was 229,000. Continuing claims, 1.96 million. The trade balance numbers, this could be interesting. I'm not sure that's going to be a hugely volatile number, but the one that Jim was referring to was the change in non-farm payrolls here. Change in non-farm payrolls down here at 75,000. Let me just double check something here. And it seems like my desktop is lagging a bit. I have been advised. Now, we actually know part of the reason why that happened. There is a Windows 11 security update that was installed that caused a lot of this lagging. Last week, we were trying to uninstall it and then prevent it from automatically reinstalling because I have security settings on my systems that basically are always double checking to make sure that I have the most recent security updates, but I'm trying to make that one invisible so it doesn't reinstall it. We'll have to check that. So I apologize if this is a little bit laggy. So what I'm going to do is try not to move things too quickly so that we don't get too much of a problem. Okay. Now, I do want to, I'm going to pull up a little bit separately here. I'm sort of looking at the return and then also what I'm getting just so I have some sense of how far behind it is so I don't start talking too far ahead of what we're seeing. I'm going to pull up a 30-year bond chart, 30-year Treasury rates going back to the 1970s, so that you're going to see that in just a second because I think this was kind of interesting event this week. So let's talk about the levels that I think are going to be important with respect to the non-farm payroll number. Okay, so again, 75,000 is the expected number. If the number is lower, that's a bad thing. Higher is better. So if it gets very low, say below 25,000 or something like that. The market's response to that is that you're going to get a weaker dollar. You are going to get lower rates because it's going to improve, if we can call it an improvement. It will increase the likelihood that the Fed will act in September in support of their dual mandate. This is really the balance that they're trying to strike. And the problem that we have is that inflation hasn't comfortably fallen below the 2% target that they have. I think many people will also recognize that, there are some elements of that which are, number one, arbitrary. Why is it that 2% is the ideal target inflation rate? But one of the things that we're also experiencing is that if, historically, we've gone through this on this channel before. If you look at historical rates of inflation during periods when we didn't have fiat currency, inflation would rise and then it would fall such that you had deflation. So, for example, you would see inflation going into wartime periods and then coming back out. There would be, surplus of goods and reduction of demand, and not only would the rate of inflation fall, but prices would actually fall. And that has not happened. And it is, this is causing some real problems in the economy, because if the median incomes do not increase at least at the same pace as median expense, whether it's housing, food, whatever, then income's going down in real terms. As income goes down in real terms, people can afford less. Then you start getting into real demand problems, and that's contractionary, which is meaningfully problematic. So I think a swing of 50,000 jobs, I mean, it's interesting because, the job market is enormous, and in the grand scheme of things, 10,000, 25, 50,000 jobs even in a labor force of over 60 million isn't huge, right? It's actually a really small number. You're talking about 0.1% of the labor force is this kinds of swings. But I do think that it is enough to change perceptions, because a lot of policy decisions are going to be made based on rates of change. So if job growth numbers look like they aren't up to snuff and up to expectation, then we might be more likely to see the Fed act, at least in a nominal way, to indicate that they are supportive of the economy. Now, they could do something like a 25 basis point cut. And a 25 basis point cut isn't going to have a huge impact one way or the other on inflation. But it could have a pretty big psychological impact, I think, on the markets if they're basically, standing in alignment of, we're supporting the market and we are supporting the labor market specifically. So I think a deviation of 50,000 off that number, small as that is relative to the job market, I think that would be enough to really change people's expectations. Of course, you could get the same thing if it came in hot, and in which case the opposite would be true. The likelihood of a rate cut would drop, and the dollar would strengthen, rates would go up a little bit. Now, the reason I showed this chart that you're looking at right now, this is the 30-year Treasury rate. And it looks like this is relatively up to speed. So what I'm going to do, let's see here, I'm going to put an annotation into this so that we can give this some context, because what I thought was kind of interesting or important for people to pay attention to, many will say that the GFC, the Great Financial Crisis, effectively began in September of 2007. Most equity market participants didn't fully recognize all the cracks that were emerging on the credit side, and how we started to see things truly break. But on the equity side, it wasn't until 2008. And so that's when most people think the GFC took place. Certainly some of the most important things did, like the collapse of Bear Stearns, like the collapse of Lehman Brothers, and arguably, I guess, just the revelations surrounding Madoff. Madoff wasn't actually managing money, so it wasn't like he was losing it. But the truth is that he probably could have carried on his shenanigans longer had people not been looking for pools of liquidity, and they thought they had it at Madoff because his returns were so stable, and so they were inclined to try to make redemptions there, and that's how his Ponzi scheme was revealed. In any case, what this chart shows us is that this last week, when we had 30-year rates above 5, they're below that now, that was really the first time since the GFC that we've seen this. Now, bear in mind that this chart is, it's quarterly. You can see that in the upper left-hand corner here. If you're ever looking at my charts and you're saying, okay, what's the measuring period? That's it. So this is sort of quarter-ending type of stuff. But I think that was kind of, I think that's really quite interesting because it does give us some perspective on rates. And I will also add that I think it's a little troubling for the housing market as I think about it, because we find ourselves in a circumstance where if rates go back to their pre-GFC sort of norms, where a 5% 30-year is the low end of the range rather than the high end, then the 30-year fixed is going to be a bit problematic. So anyway, I think the labor market data that we're getting at the tail end of this week is going to be important. So I'm going to quickly scan through here and see whether we have any other sort of macro-related questions. Lulu, yeah, I see that. Okay. Will I have an office hours broadcast? Whether I have an office hours broadcast will depend a little bit on Mark Guthner, with whom I usually do that. This being a new semester, I have to confirm with Mark what time he's actually available for office hours, because we're actually taking a section of his office hours. That's why he's doing it from his office at Rutgers University. So, okay. So here's a name I don't know that I've ever discussed before. Ticker is CPRT. This is a company that is in the auto parts business. They service insurers. So what they do, as you can see here, I don't know if I can blow this. Let me see if I can blow this up. Can I expand that? Yeah, you guys can look this up. But basically what they're doing is, and it just shows, how in a dynamic economy you can have businesses that, specialize in fairly narrow things. And what this company does, and we'll just take the Hoover's description here, is that they are providers of online auction, vehicle remarketing services, and they work with insurers and auto dealers and fleet operators and vehicle rental companies, as well apparently as individuals. Although I think that usually once you start dealing with circumstances like this, where I do know that there are individuals who try to deal with situations where you have a damaged vehicle and where there's an insurance claim and questions about whether or not it's going to get a salvage title. That can be fairly complicated. I have a friend actually who's kind of a car buff. Very short story, but he bought a Mazda minivan many years ago, and he uses it as his runabout all around the San Francisco Bay Area. And he has many other cars. He's Porsche and a Cadillac Lyriq, but he loves this old Mazda. And he's very proud of the fact that he was closing on 300,000 miles, and he maintained it impeccably. And somebody sideswiped him, and very cosmetic damage. And then the adjuster came out, took a look at the car, and they were going to total the thing. And he, being a car guy and just being proud of how he'd taken care of it, and disgusted that you would total this car, which was impeccable other than its high miles, and he knew that because he had bought it new. He went through the hassle of buying this thing from the insurance company because he didn't think the car should be scrapped. In any case, it probably does still have a salvage title because of what they did, but in any case. So this business, as it turns out, is quite a good business to be in. How good a business? Well, let's take a look at the company's operating results over the last several years. Now, their pace of growth has slowed, and it is forecast to grow still more slowly over the next year, but still quite good. So, what you can see here is that year on year, from 2020 to 2021, 20%, better than 20% revenue growth, and 33% net income, adjusted net income margins, and year-on-year adjusted EPS growth of about 45%. And that those numbers were 20. If you can't quite make it out on the screen, I'll just read them off. It was 20% growth from 20 to 21. You'll notice that their fiscal year ends end of July. So, what we're going to be dealing with is their full fiscal year results when they report. 30%, 10.5, 9.5, 10. The expectation for their top line growth year on year between 24 and 25 is 10.4%. Slightly better than what they had last year, but all within spitting distance of one another. Adjusted EPS growth, which had slowed over the trailing 12 months, is expected to be 11.7%, very solid. Remember the sort of benchmarks that I generally provide for companies that I'm interested in taking a look at. Are they growing their top line faster than the S&P is? Are they growing their bottom line faster than the S&P is? Do I think that they have maybe not just a moat, but at least some business that has some room to last for some period of time? And the answer is yes. Their revenues have been growing faster than the S&P, and their adjusted EPS growth has also been growing faster. Because remember that the adjusted EPS growth for the S&P overall has probably been around 8% in the last couple of years. And we don't need to split hairs about it, but it's in that neighborhood. Free cash flow. Why don't we take a look at next year's estimated free cash flow to sort of get a sense of what the yield is? Because if you buy today, that's what you expect to get. What are you buying? You're not buying what is being delivered to shareholders of old. Nevertheless, it's impressive to see that they've been able to deliver that for some period. Let's just call it $1.21 billion to keep the math easy. So over the current enterprise value, which is the market capitalization plus net cash, because the company essentially has no debt. It doesn't have debt. It actually has net cash, so look at it that way, is a free cash flow yield of 2.86%. Not the highest free cash flow yield we've seen, because we've been getting some numbers that look like 4 or 5%, but growing very nicely, because that represents 20% year-on-year growth. So our next question for this is going to be, okay, well, how does its valuation at the moment stack up with its historical numbers? So again, just looking forward rather than backwards, because what the company is going to be giving you over the coming years, what you're buying, that's going to be $1.73 is what the street is looking for. And what is the current share price here? I was just looking at this a second ago. In fact, I think I had it at the top of the screen, but it went away. 48. So 48, 173. Yeah, we're looking at about 27.7 times full year, next full fiscal year's expected earnings, which is a slight premium to the S&P, but like we just said, their numbers have been better than the S&P's. Okay, so how does this stack up to the company's historical valuations then? It's a discount, right? So if you're looking, I don't know how well you all can see this. I'm going to try to blow this up just a little bit so you guys can see this a little bit better. Really fill the screen with this. Okay. So as you look at this, the part that is probably going to be of interest to you is this range. So this is the 2-year historical range over here right in the middle of your screen. The orange diamond represents the historical average, and the blue dot represents where those multiples are today. So that essentially what you're looking at is in the entire range of valuations based on these multiples, based on forward price to earnings, forward enterprise value to EBITDA. Well, it's forward, really the way to say it. I mean, we say forward price to earnings, but really it is forward earnings to the current price, forward estimated EBITDA to the current enterprise value, and so on. But the short version of it is that the company is cheaper than it has historically been. We already went over why that would be true, and that is that this was a company that had really exceptional rates of growth. We're talking about 20, 30% top-line growth, and that has slowed somewhat, but the numbers are still very good. So simply, do I think that the valuations are reasonable here? I do. I do think they're reasonable. So the next question we probably want to ask ourselves is, okay, well, how's this thing setting up technically? For that, I'm going to just rely on, we'll take a look at over the last year or so what the best performing technical indicators have been. Generally, most of the better performing ones, as we can see here. And by the way, I should also point out that when we're, oops, let me wait for a second because it's running this. Yeah, okay, so we're probably lagging by about 15 seconds or so, looks like to me. Most of the indicators are positive here. And remember, this column over here, we're just ranking on the best performing technical indicators over the course of the last year. It's making, the backtester makes an assumption that you are using 100 million capital base. So if we think about it this way, if the S&P is up, we'll call it, 15% or something, then that number would be 15 million. So basically what this is telling you, that these technical indicators, had you followed them, would have significantly outperformed just a buy and hold in the S&P, and probably just, a buy and hold in most things. So generally, they are positive. The best performing indicator is the commodity channel index. That one actually has it short, and it's down a little bit. The stock is obviously, so this is one way to read this is you can say, okay, it has a short position. This P&L here is the P&L since that technical indicator did the last thing that it did, which in this case is go short. Something like a commodity channel index, some of these indicators are, kind of like relative strength indicators of one sort or another. And that's what you're kind of getting into here. You can see that, it probably violated over here. That's when it went short. And in fact, it has outperformed. In fact, that's exactly what we can see. We can see that it actually triggered the short right here, went above this upper band, and then stayed there basically. But it's now heading back. So one of the things I would say about this is that, you can kind of look at this indicator and say, all right, do I think we're actually headed for the green band here, which would actually be that point at which the commodity channel index as a technical indicator would go long. All right. Oh, you haven't seen the bands yet. Okay. So I'm just yammering away. We're going to leave that there for a second. Hopefully this comes up. Oh yeah, that's what we could do. All right, so let me boot that up. Okay, I'm going to fire up another mechanism for screen sharing here as soon as I'm provided with a link. I will not connect the audio. So we're going to use a different software package to share. Fire this up. And I'm going to ask the crack production staff, so make sure I don't join the audio there. Does this mean I kill the NDI? Okay, so I'm going to hit the share over here. And I hope that you guys can... There we are. All right. Apologize for these issues that we're having. I've done quite a lot of things to try to improve the bandwidth around here, but unfortunately, I'm not getting everything to work just right. Okay, so at this point, you should be able to see the commodity channel index that I was talking about. So this is the best indicator. I'm going to actually take that off my ears because now I'm hearing myself as a result of the software that I was using. The thing that you want to pay attention to here is that if this gets down to the green, that is going to be an indicator that it would actually turn bullish here. So far, I would say the fundamentals support this. The technicals generally support it. And so let's take a look at what the options market is now forecasting. So we've got an implied move of about 7%. Last move was about 11.5%. So this is, yeah, I mean, this is pretty consistent. One way to think about this, if you take a look at the last 8 quarters, I think that's usually representative. Too much further back than that, I'm not really crazy about going back and saying, okay, how did a stock report, how did a stock behave after earnings 10, 15 years ago? Imagine doing that with a company like Disney, for example. It's a very different world we live in today than where Disney was when they basically ruled the world of cable with ESPN and things like that, before all of the cable cutting and all the rest. So we like the valuation. We think it's reasonable, I should say. I mean, is it screamingly cheap at 27.5 times forward? It's not screamingly cheap, but it is very reasonable valuation, very good price to growth. I would actually suggest that maybe right in here, this is sort of the level I particularly like. And maybe, Ranjana, you can tell me whether this is kind of where you began to pick it up. But this level right down here does look pretty interesting to me. So with that in mind, and with an implied move that's at least fair and maybe a little bit high, I don't mind being short options in this, looking to collect a little bit of premium. My comments about this being a higher volatility period than usual notwithstanding. So, potential trades. You could look, if you just wanted to make this a binary going into the print, you could do something like, buy an in-the-money call spread, for example, so you're not really laying out a whole bunch of in-the-money premium, extrinsic premium. But I also don't mind something like a call spread risky or a calendar spread of the same variety. Let's just take a look at longer term implied volatility really quickly before we make that final judgment. So if we look out to, let's just go out 6 months. We'll look at 6-month implied vol. I'm going to get rid of the realized one for a second, and I'm going to take a look at this over a 2-year time frame. That's pretty high. Now remember, this is a company that has net cash, right? So it's not like there's a lot of leverage on the balance sheet. So that's kind of interesting that we're seeing that uptick in implied volatility. I think probably a call spread risk reversal is not a bad idea here. We can just model one up, keep it easy. Stock 48. I would probably use a slightly higher strike than this, but it's tough because we're dealing with $2.50 strikes on a $45 stock. But yeah, we'll use something like the 50, 55. That's a 16 delta. Good enough. And where does this put us? So you would be looking at a trade like this one. And again, because we don't have a lot of resolution with these $2.50. Remember, when you have a $500 stock and you've got $5 or $10 increments, you're dealing with, you have pretty good precision with respect to the moneyness relative to the stock. But here we're dealing with a $48 stock and $2.50 strikes. So, it's more than 5% of the stock price for each one of these. But I think this would be a decent strategy. I'm wondering, I wonder if we have, I'm going to pull up the Options Trade AI platform and just see whether we happen to have the vol crush data for this one handy. If we do, I will share that. Let's see what we've got. Again, this is, like, I think this might be the first time I've ever looked at this name. Okay, so let's just bring this in. Hopefully you guys can see this. This is so the vol crush numbers are over here, right? So you can see the volatilities before and after. So you're looking at least 17. Well, actually here there was only a 12% crush, but in general, pretty good vol crush that comes out of this. Yeah. So luckily we did happen to have that handy. So yeah, I think that would be fine. I also think it'd probably be fine just based on where the stock is. Remember that 45 was kind of the lower end of that range. So if you're sort of thinking you could bump that strike up. Again, the problem being that 5% of the current stock price. So, you know, do you want to sell a 15 delta option or a 22 delta option? Kind of up to you. If you did change that to the 45s, that probably gets us to flat or to a credit, right? Or that's flat. Yeah, small. Yeah, basically flat. So that's what you're going to have. So Ranjana, I'm not sure if that helps you, but you know, thanks for bringing up a name that we don't often talk about. It's nice not to talk about NVIDIA for once, I guess. Okay, so let's see what else we got here. Hello, Mike. Broadcom reports tomorrow, and it's on an uptrend near all-time high. Expect another uptick. This is interesting because I'm not really enamored, probably nobody is, of, you know, NVIDIA delivered some good numbers. Suddenly we're back to talking about NVIDIA. And I'm not, and Alex, not taking issue with you for getting me talking about NVIDIA again. It just feels like we talk about it an awful lot. Oops, before I get to Broadcom, let's just take a look at this one. Because the reason the stock didn't perform so well coming out of earnings was because they, in their own comments, forecast you know, a slowdown in CapEx growth, right? So that's going to affect everybody in the space. So the question that we have is not whether or not Broadcom's going to deliver a good result. I think that they will, in much the same way that NVIDIA did. The question is whether we're going to get similar types of comments out of them. And if we are, how does that work in terms of supporting the price action and this issue, which I was showing for core, right? Which is, do I have this blown up a little bit too much? Let me just take this down just a little. There we go. Where the valuations for Broadcom are not at the lower end of their historical range over the course of the last couple of years, but at the upper end, right? Now, what are we expecting? So we're expecting good results, and I think that those will continue. I just think there's a lot of good news priced in here. And I would not be surprised to see price action similar to that we already saw in NVIDIA, frankly. And, you know, look, we kind of are in this whole space overall. I mean, you can see it kind of leveled off here. So semis, you know, after this huge run off the Liberation Day lows, have been struggling just a little bit to set new highs. And, yeah, I kind of expect that to continue. So if that's true, think about this. The NVIDIA implied move was actually a pretty good sale, as it turns out. And, that might end up being the case here too. Just simply because, you're running into a little bit of exhaustion. So, now I will also say that it's not my inclination to sell stocks going into a print, simply because I think it's going to be hard for them to deliver what they did, for example, back here when they reported their Q4 24 results last December, and the stock rallied 24+% in a day. I think is going to be challenging. That doesn't mean sell the stock now. First of all, there could and will be, for many people, tax consequences. Secondly, what are you going to do with that? Do you dump it into cash? I mean, sell and go short? No, we're not going to do that. But, would I add to longs here going into the print? I would not. So, yeah, not the world's most compelling comments, but that's my thoughts on Broadcom. You also asked questions about LULU. So I saw an article come out about LULU today that really kind of annoyed me, I have to say. Maybe we can find it. And actually we talked about LULU on Fast Money, I think, last Friday. Julie Beal was on. They didn't ask me about it, but I think I just chimed in from the peanut gallery. And the comments that I was making about it was people were suggesting that, Nike might finally be on the right track. And that, there were reasons to buy the stock and blah, blah, blah. And what I found fascinating about that was, here's a company that does not meet my criteria. It has not been growing. In fact, it's been shrinking. They had peak margins a couple of years ago. I don't expect them to come back. So you had declining top lines, declining margins, great brand, what I believe to be good management. We had returning executive who'd been there and seen some of Nike's best days. So don't question the competence of the guy who's at the helm. I just thought it was a hard dynamic. And even more than that, I thought it was a hard valuation. This thing is trading, more than well over 30 times EBITDA. EBIT. I prefer to use EBIT to EBITDA. And that I thought was a little bit problematic. Now, if you take a look at LULU, we've got Nike at 33 and change, and LULU's down here at 9. Okay. So to me, if someone says, okay, you have to make a choice, do you want to be long Nike or LULU? I'd say I'm long LULU. If you have to be short one of these, I'd be short Nike and long LULU as a pair. Just based on the valuation difference. And now I recognize that LULU's growth has slowed materially, and they don't have as much diversity in their SKUs as Nike does, which is going to be a little bit of a problem. But I still think that valuation gap is an awfully big one. So what was it that I saw earlier today that upset me with LULU? I thought I saw an article saying that they were going to adopt Nike's strategy. Oh yeah, here we are. Right there at the top. Lululemon bets being more like Nike will help ailing stock. Really? I mean, if the question is, do they want to slightly broaden out the products that they have, I can go along with that. Going down the avenue of saying, okay, can we really get into the shoe business? That's a little bit more challenging. I think there is some merit, which they have not typically had a lot of, sort of endorsement deals the way many others have. And they're doing some of those now, and I don't object to that, to be sure. But I wouldn't take all of my cues from Nike. I really don't like the fact that Nike sort of got onto this scarcity thing where, people started to think of shoes as a tradable commodity, and they were speculating on them. That's not really a good long-term story. I actually wrote an article about a completely unrelated apparel company, and that was Ralph Lauren. Now, Ralph Lauren's valuation, it's a little rich. It's had a huge run. Stock's up like 64% or something like that this year. But think about a company like Ralph Lauren. Here's a company that their fashion, now they started to they had gone more towards a younger, trendier demographic a few years ago. They've sort of pivoted back and said, let's just focus on our core demographic, wealthy people who are looking for aspirational, traditional, preppy, Ivy types of apparel. The nice thing about that is you don't have to change your product very much. It doesn't go into and out of popularity. The margins are exceptionally strong. It's interesting that at Pebble Beach, the Concours d'Elegance that took place recently, a lot of the people there were dressed in apparel that's probably very similar to what shows up at Ralph Lauren's Rhinelander Mansion flagship store on Manhattan's Upper East Side, and probably does not look a whole lot different. As I put into my article, I said, the things that these people are wearing probably doesn't look a whole lot different than what people were wearing when the car that won Best of Show, which was a 1924 Hispano Suiza, was originally built. Because those fashions basically stay the same. Largely looks like the catalog looks like something out of The Great Gatsby, which, by the way, if you ever watched the 1974 version of that movie, Ralph Lauren, who I think was possibly employed or had been employed by Brooks Brothers at the time, was actually the costume designer for that first version of the movie that came out in 1974 starring Robert Redford. But in any case, I don't think migrating too much towards trendiness is a good idea. I don't mind the idea that they can sort of associate themselves with some athletes and sort of raise brand awareness. Francis Tiafoe is a tennis player. That's one of the sports that Ralph Lauren focused on. Lewis Hamilton is a Formula One driver, which is the upper end of motorsports. So if they stick with that, I think that's a good idea. They're a premier sort of marquee brand, cater to an affluent demographic. As long as they stick with that, I think it's a good idea. So I like LULU here. Obviously hasn't been doing great, but I think the valuation story is fairly compelling. The technical story remains pretty dismal because we don't have any anchor point here where we can say, okay, this is it. I think the damage is done. But the valuation story is beginning to get very interesting. And as long as the fundamentals stay in alignment, which we're about to see, so do you race out and buy this thing? LULU was a long-time Holly Index stock of mine. You race out and buy it pre-earnings? I don't think that's necessary because I think it's unlikely that they're going to blow the doors off their numbers. Let's take a look at some of the alternative data and see if there's anything lurking in there that... so let's take a look at this. So Bloomberg's second measure is showing LULU basically spot on with the industry overall. I'm obviously a big Bloomberg user. I haven't personally seen such, great predictive indicators out of second measure. I have found that Placer AI is a little bit better. Remember what Placer AI does, which I think is really slick. So they're basically observing. They have a huge sample of mobile devices, and they can actually see where people are going. According to them, at least, year-on-year foot traffic is down, but not down as much as it is for the industry overall. And by the way, this still goes back to my whole thing about Nike. Like, why am I going to buy this thing at more than 30 times EV? But I have a hard time with that. When, it's headwinds for the industry. So if it's headwinds for the industry, you've got to think that you want to have something compelling, like valuation, to support what you're doing. On the webside, this is also, I think, kind of interesting, which is that the industry is down 6.6% year-on-year in foot traffic, but up 6.5% year-on-year in web traffic. That's not as true for LULU. So, again, this is a little bit of a mixed bag. Do you need to rush out and buy it going into the print? No. It is a big implied move, though. When I was looking at this last week, let's see where it is now. It was 12% or something. Let's see where we are at. Now, it's a little bit lower now. But that's, that's a pretty big number. And we've already had some big swings recently. How much leverage have we got on this thing? Because that, I think, is going to be important. None. No leverage. $400 million of net debt or something like that. It's not even. So, here too, I don't mind being short options on this. Be willing to stomach a little bit of pain. So this also would probably set up pretty well for a call spread risky going into the print. Just in case they came out with something a little bit better, I'd lean long just on valuation. If you do get a move of, call it 12% up or down, if we just take a look at the kinds of moves that we've seen historically, it would be a push in these cases over here. If you do a call spread risky that's targeting that implied move, in a big down move like this, you're going to lose, 8% of the current stock price, kind of worst case, which isn't a complete disaster. So low probability of losing, call it 8%. Decent probability of, getting somewhere between 0 and positive 12%. Not a horrible risk reward. So again, you would just set up a short strangle, buy an at the money call, hope for a little bit of all crush. So yeah, I like that. Let's see what else we have. And okay. Already addressed the office hours. Bob says, Valero broke its 52-week high today, but quickly reversed. You're writing the Sept.19th at the money 155 long calls. Looking at RSI and volume, will it continue to rally up, or September swoon will prevail? Thoughts? Thanks. Well, let's have a look. Let's look at the technicals first, since you brought them up. Oh, you know what? Did I kill? Now I've got extra things running. I'm probably going to exit that. Yeah, I'm running a bunch of extra applications. So if things are slowing down because I'm running multiple screen sharing applications, I'm just going to kill this other stuff. Hopefully that will speed things along. So, you said you were long on... So on the RSI side, it looks like you were long, huh? Oh, you're asking about RSI. Okay, so this is not necessarily the reason that you were long or are long VLO. Well, look, I mean, the top three indicators are bullish here. And let's take a look at RSI specifically since you mentioned it. And yeah, it was because it hit that high that the RSI is now short. So if relative strength is your chosen indicator, and it's been a pretty decent one for Valero, not the best one, but it's been a good one. It might be a little bit exhausted or overbought here would be the way we would put that. But why don't we take a look at, so these other indicators have similar characteristics. The trend still being your friend, but why don't we take a look at the best one, the moving average oscillator. And yeah, I mean, what you're looking for here is that crossover, and we're still a little ways away from that. And you're September 19th, 155. So let's take a look. So what do we have on the calendar for Valero before expiration? Nothing there. See what you paid for these suckers, or what you're paying at the moment. By the way, folks, next week I am going to be at the Hood Summit in Las Vegas. I am going to try to do open mic. But Wednesday I'm actually moderating a panel at the summit. And that is before open mic would normally take place, but I'm not sure I'm going to be wrapped up because they have a Q&A session afterwards. So I apologize for that if there's any reason I can't join. So these things are 40 cents in the money. We'll call it $4 worth of extrinsic. So that's 2.6% of the current stock price. And we've got, what are we here up here? 16 days to go. Let's take a look at what the long-term, we'll actually just look at the year-to-date here. So volatility has drifted off a little bit recently, but the average, so the average is 38. I would actually exclude this. Let's just call it even 30. Okay. So we can do a little bit of quick math here. So if we take 30 and we're going to divide by the square root of 26, which is 5. 6 divided by 2. I think those options are very reasonably priced. Yeah, there's pretty much spot on fair value. So if you're inclined to be bullish here with a short-term perspective, those calls are actually pretty reasonably priced to do that. You know, based on how volatile the stock has been over the course of the entire year. Not so much lately, but do I really think that, you know, with volatility in other areas picking up, is this suddenly going to become the quietest part of the market? I kind of doubt it. Plus, we were dealing with a lot of macroeconomic things coming up. And, you know, the refiners are going to play into that space. So, yeah, if I was going to press along the way you've done it, it's probably the way I would. I would probably go out a little bit further in time myself. You know, 2 weeks is one of those kind of painful areas to just be straight long options unless you have an identified catalyst, and we don't have one because they're not going to be reporting earnings or anything like that. But we do have some of these other economic announcements coming out. I'd probably want to be long a slightly longer dated one myself, but if this is your preference in your time horizon, those are reasonably priced. Okay. Right. Is really what constitutes a dip nowadays being down 1.5%? No. Certainly not. What is a little bit of a dip, though, is when you get a 1.5% move within a day, and we got one on Monday. We rebounded off of those lows. But what I would point out, this was one of the things that I've said it more than once, but for anybody who's watching this for the first time, one of the things that I have observed when you have a market that's been up for a long time, is at or near its highs, that one of the cracks that will begin to emerge in the ice is that volatility is going to start going up. And what I mean by that is you're going to see these price jumps or price gaps that are unusual or anomalous. We had, I think, a 1.5%. Why am I saying I think we had? Why don't we just double check and see exactly what happened? But we had a pretty big gap down on Monday, right? So this was, you know, and we rebounded, as you can see here. But from the closing price to the subsequent low was 1.5% exactly, right? Over the course of a week, is this a significant number? Not hugely so. But that's a big move for one day, right? If you think about it this way, if the volatility for the S&P is on average, we'll call it 12%, okay? Or, yeah, when I say the volatility, I'm talking about the standard deviation. So if the standard deviation is 12, let's call it 14. You divide that number by 20, and that's going to give you your daily average move, the mean absolute deviation of 70 basis points. 1.5% move is more than twice that amount. So more than double the move that you would see on average. So that is a pretty significant move. Does that mean we're rolling over now? No. But if you start seeing, kind of moves that take your breath away a little bit, you're going over the roller coaster. And I always remember when I was a kid, my mom was driving the car. We'd go over a rise in the road. Cars had very squishy suspensions. You get that sort of, lightness in the seat. You sort of feel like your breath coming out of you a little bit as you went over a rise. That's worrisome to me. That's 100% what we saw when the tech wreck. I'm not saying this is a tech wreck situation. There were a lot of companies in 99 and 2000 that not only weren't profitable, as many of the biggest and best companies today are profitable beyond measure almost. So, there's a lot of things that are different about what we have now. But just in terms of price action and sentiment, if you start seeing big price jumps in individual stocks or in the indices, that is a worrisome sign. So I would offer that. Alex V. So Broadcom, sell call spread to capitalize on volatility drop. Yeah, I think that's all right. Against the long, if that's what you're talking about, sure. Joseph Gaiman says, bought Google vertical at 10 spot 2. Okay. It's interesting. So you're talking about, I think, the October 2nd expiration? Is that what I'm assuming you're referring to? Alphabet has been a little bit of a thorn in my side for the year because, as some will know, it was in my rising acronym. So the CNBC rising acronym was RSING, where the G was for GOOGL, Alphabet. The one that I did for this channel was with 2 Gs. One was for Alphabet, and the other was for GLD. And the ruling that we just got, where they don't have to divest Chrome, I think that was the right outcome, but they can't have the exclusivity deals, actually was what pushed my acronym X Gold. My CNBC acronym is now outperforming the S&P thanks to Alphabet. And of course, the rising one already was outperforming, but now it's outperforming by more. By the way, just, I'm not trying to pat myself on the back because I'm by far not the best performing pundit, if we'll call it that, on CNBC this year. Guy Adami is outperforming me significantly. He's got like 33% total return year to date. But I actually would argue that more impressive than that is Steve Grasso. Because Steve Grasso's total return is in the neighborhood of 32%, so he's just trailing Guy. But he came in second place to me in the acronym challenge last year. We both crushed the S&P, and he was like neck and neck with me. So I think that's more impressive. I mean, I don't really care whether somebody's going to be up 33% in a year or 31% if year after year after year you're delivering really good results. So I don't know what Steve's results were in 2023. I've got to go back and look. But he's crushing it this year, and he was crushing it last year too. So that's really good. So kudos to him. I think Karen Feinerman's doing pretty well this year as well. And she's very much a value investor. So that's notable because she's not going to be typically in high beta names. She's not out there rolling the cubes saying, okay, we'll take a flyer and, anything like that. She tends to be a very conservative investor. So to outperform significantly, with conservative investments is also notable. So credit where it's due. Not that anybody's tuning in to watch this to find out how those people are doing, but I just think it's interesting. Okay, so let me just quickly scroll through. Did I get most of the questions? So Joseph, question above. Did I miss your question? Oh. Okay, so above for you is below for me. So I was actually looking in the wrong direction. Months ago, I bought 2 Google September 185-210 call verticals. All right. Let's go through a very specific example. Nice. I like that. And this is good because now we get to go through a real world example of a good trade. Well done, sir. Now the stock's had a big move. What do you do? So you bought 2 of the SEP 185-210 calls. Today you sold or closed 1 for $24.45. Can this gain any more, or am I maxed out? Well, yes. So well, no, actually, not really. I mean, if you held it to expiration, it would go to its intrinsic value, which would be $25. But the idea that you're going to buy a call spread, it runs through both strikes, and it's now worth almost all that it ever could be, right? So it could be worth as much as 25. It's worth $24.50. So you could make 50 cents on a $25 vertical if you held it. Yeah, you close that. Take the money. For sure, you take the money on that. No reason. I mean, that's not a great rate of return on an options trade where you're essentially, here's the way to think about it. You are now, by holding on to that, if you do not sell it, you are functionally equivalent or synthetically equivalent to being short the 210-185 put spread at 50 cents. Is anybody watching here just lining up to sell a $25 put spread for 50 cents? I'm in a stock that just had as big a move as Alphabet did? No. You did the right thing. If you sold one and not the other, sell the other. sell them both. That's the short version. But good trade. Well done. Well done. I'm sorry, you said question was higher up, and so I was looking higher up, but it didn't scroll further up. For me, the older questions are on the bottom. Maybe I can figure out a way to let's see, maybe can I sort that differently? No. Okay. Let me see if I missed any others. So we got to core. Ranjana, thank you for that question. Love the questions on names that we haven't talked about, even if these are names I've never looked at myself, because you're just bringing the attention to it that I might want to have, and I think it's good for us to work through these things together. Somebody else said, Donovan Young said, nice hat. So this hat was a gift for me from our notable producer, Jay, who is on the East Coast, and the one that has to deal much more significantly with the frustrations of technical challenges than I do. So, how and why I get the gift, I don't know, but I really appreciate it because I like this hat. I like this hat. He gave me this mug, too. So these came together. So I like them. Maybe at some point, these things will be available, or we'll send them out as gifts or something like that in the future. Okay. Well, I have chewed up more than an hour with some technical difficulties along the way, but I appreciate your tremendous patience and the excellent questions we had today. Joe Kamen, well done on Google. Ranjana, I like you bringing up CRPT. That's an interesting stock for us to talk about. And yeah, I mean, LULU's at some point, technically, it's got to start. No, it doesn't have to. I mean, nothing has to happen. So the idea that it has to have a bearish to bullish reversal is not entirely clear. But I will say that on a fundamental basis, the valuation is starting to look pretty compelling. And FinWest, this will be my last attendance during the sunshine, returning to Bangkok Saturday. Safe travels to you, FinWest. So for all of those of you who stuck around for the full hour, we really appreciate your time and attention and your excellent questions. I hope what I had to say about those things were helpful. And we really look forward to seeing you in the next live stream, which, assuming my flight does not get delayed to Las Vegas next Monday, will be at 4:15 Eastern Time, and I will be joining you from the Virgin Hotel in Las Vegas. And assuming Professor Guthner is available from Rutgers, and he does indeed have office hours, we hope to do those on Friday. Thanks for watching.